ending at day's low. For a moment, one thought that there would be some amount of short covering because we've been down for like 7 days in a row now, but it's not obliging the consensus. Bulk of the market believe that we are in oversold territory and some rebound is warranted, but it's not happening. Even for the series gone by, in fact, two back-to-back series, we've seen almost 3% kind of cut coming in. If you go to the broader markets, the damage is much higher. So what's the prognosis on the markets from here on? The guest on my show today is Jitendra Gohil, Director Investments at Credit Suisse Wealth. Jitendra, afternoon. Thanks a lot for joining on my show today. We're chatting after a long time. So what's your hypothesis in the market? Everybody thought that inflation is peaking out and the works, but then the data coming out of US, here back home in India also seem to be suggesting otherwise. What are the other worries to your mind?
Hi, Ajay, and thank you for inviting me on your show. It's been a long time, I guess. So Ajay, what our house view is, first we think that Fed will have to keep interest rates higher for longer, and unless we see marked slowdown in some of the large economies, we will not see this inflation will come down in a hurry. So what it means for emerging market is that we might see more outflows. We might see more stress in currencies. You've already seen some of our neighboring countries how they have seen significant downturn, and I think environment is pretty tricky as of now. While on the India front, we think that macroeconomic fundamentals in the medium term remains very strong. And we think that any correction, probably another 500 points or so on Nifty, could offer a buying opportunity. So overall, our house view is that in the first half, we might see some kind of correction and some kind of consolidation. But in the second half, we think that there could be a good recovery.
Jitendra, how are you looking at the valuations and which are the pockets of valuation which you are liking right now, which this fall, further acceleration of fall, if which you're referring to comes, would you utilize to get your positions back?
I see last year was phenomenal for Indian equities. We have outperformed and surpassed all other expectations. What we feel is valuation has already corrected from, let's say, around 22 times 12 months forward ratio to around 18 odd times. So I think valuation froth is settling, but still India is a little bit expensive compared to other markets. So we still think that there could be some more correction. However, if you look at pockets of valuation, comparison, I think IT is still expensive. So we think that in terms of correction, I think IT might see more correction in the near to medium term, while banking sector looks pretty attractive at this point of time. Even after this correction, I think some kind of a near-term consolidation could be on cards. But I think from a medium-term perspective, valuations for banks looks very attractive. So I think one should look at these kind of sectors where valuations have corrected, and we think that this could offer a good buying opportunity.
Jitendra, I want to know your view on the mid and the small cap end of the market, where bulk of the damage has actually been done. Any themes, chemicals, auto ancillary, apparel, manufacturing, or any in the consumer side which you like there, which should be utilized to build in positions once again?
See, we have slightly, you can say, a kind of counter view compared to the market. We think, mid caps are attractively positioned for India in the next 2-3 years view. If you take, there are several opportunities that mid cap sector offers, and we are buyers of mid cap, and we have been maintaining this view for the past almost a year now. What we feel is in the mid cap space, if you look at some of the stocks which have corrected almost 30, 40, even 50%, we have started buying those stocks. For example, right now, consumption sector is seeing a lot of stress. One is because the lower end of the consumption demand is very weak. Secondly, we are also experiencing, down trading, or you can say even the inventory levels in the system is very high, which we have seen that kind of now normalizing. So from next couple of quarters perspective, I think consumption may remain under stress, but that could offer a very good buying opportunity. So we are playing consumption recovery probably starting from September onward, and hence we are positioning on that aspect. Second, we think a, a nice story is developing around the textile sector. So textile sector, I think one has to look at from around 6 to 9 months perspective. A lot of destocking has already happened. Retail sales in US hasn't been that bad, and I think the global growth outlook isn't that bad as market was expecting earlier. So I feel that textile sector, export oriented sectors could see some kind of pickup in the next couple of quarters or so. So these are the sectors that we look at. Secondly, we are also a little bit concerned about the weather conditions. You must have read the reports in terms of El Nino and the kind of drought situation. But I feel that it's very difficult to anticipate. But I still feel that some of the agrochemical companies can start to better. So I feel that some of these pockets of opportunity definitely offers good buying opportunity, at least from a near term perspective, which are there in the mid cap space.
What is your hypothesis on rates? Do you see in the second half peaking out of rates and rate cuts starting, or it is early to say? A lot of other variables will play out. When can we expect rates to really start coming down?
So Ajay, we have been very clear in our communication to our investors that Fed is going to keep rates higher for longer. We are not going to see cuts in the second half. In fact, our house view is a little bit negative on overall equity market. From India perspective, also, if Fed continues to tighten and keeps the rate higher, it will be extremely difficult for the RBI to start cutting rates. So cutting rates is it's pretty tough call, but I feel that rates will remain higher for longer, and hence there could be some more correction in terms of valuations. Having said that, market is forward looking. Market generally looks at 12 to 18 months perspective. So once we are into second half, market will start projecting rate cuts in the next year and the year onward, 2024 and 25, and hence market valuation may starts to bottom at that point of time. And hence our house view is very clear. We feel that first half is going to be really volatile. We might see consolidation or correction, but in the second half, when market starts to factor in 2024 and 25, where we see that there is chance of good rate cuts happening.
All right, Jitendra, thanks very much for chatting with us today on the show.